US federal debt has increased once again to hit another record, now at a whopping $35 trillion. This means that in less than 7 months since the start of 2024, the debt has climbed by $1 trillion and also means that the debt has ballooned by a staggering 50% since January of 2020. This now puts the national debt to GDP ratio at 121.7%, which is far higher than levels seen pre-pandemic, signifying how out of control the debt problem has become post-2020. With debt continuing to surge to new highs, government interest payments on this ever-climbing debt are also starting to get out of control while we remain in this high interest rate environment. Federal government expenditure on interest payments has now reached almost $1.1 trillion annually, which is far above any previous point in history and now even exceeds spending on national defence. As a percentage of tax receipts, this equates to around 35%, highs that have not been seen since the 1990s. And this now shows clearly how much of a burden that this debt is having on the government's ability to spend on other things that will actually positively impact society and the economy. When we look at the growth in government debt compared to the growth in nominal GDP, we can see that debt growth is outpacing economic growth, and this gap between the two is only likely to get wider as interest expenditure becomes a bigger burden on the government. In a new memo to investors from its private banking arm, JP Morgan analysts do say that there are underlying risks associated with America's ballooning deficits and high sovereign debt levels. The note said, "The bottom line for investors is that we don't expect meaningful improvement in the trajectory for US debt or deficits in the medium term." On top of this, they warned, "The risks are meaningful enough to consider adding non-US dollar denominated assets and real assets such as infrastructure, gold and commodities to traditional multi-asset portfolios." Now, JP Morgan does highlight limited fiscal flexibility due to high debt and wide deficits as their number one most prevalent concern, and the government hampering their ability to respond effectively during future economic downturns could be very problematic. This is because historically, during recessions, governments do boost spending to stimulate growth. However, next time around, the government may not have the fiscal space for additional stimulus thanks to an already large budget deficit. You can see this in action on this chart, with the government budget deficit spiking to above 10% for a short period of time during the global financial crisis, and then also briefly during the 2020 pandemic. Throughout all of history though, the baseline budget deficit has never really exceeded 5%, and for some periods of history we even saw a budget surplus, giving the government this added flexibility to widen the budget deficit and support the economy during later times of needs. Now, this situation we are facing now, however, is one where we are going to have no more years of budget surplus, a baseline budget deficit consistently over 5%, where the Congressional Budget Office expects it to exceed 8% by the year 2054. And here we really see the debt-death spiral that analysts often refer it to play out, as the majority of this increasing budget deficit is expected to be coming from higher net interest outlays for the government. And in fact, the White House now expects $2 trillion in deficits by the end of the decade in an updated budget estimate from the Office of Management and Budget, which forecasts even larger budget deficits since the original estimate. These heightened deficits are well above levels that were typically seen during stable economic times, which is an unsustainable fiscal path. Reduced government fiscal flexibility could result in a slower economic recovery and more pain for those who are hit the hardest during the next recession. What's even more alarming is that signs are starting to show that the US government is about to face a critical problem which they have never really had to face before in the past, which could unwind the entire financial system. Now, the US government requires investors to buy this debt from them to be able to continue to run large budget deficits and run up national debt even higher. With debt buyers being a key component of this ecosystem, if buyers start to lose their appetite for US debt and withdraw it from the market, stopping any more purchases of new US debt that is issued, the US government faces a big problem. We're seeing rising concern around the US government's borrowing addiction, and this has already led to a number of hiccups in the bond market, with debt auctions seeing weak demand. This has resulted in primary dealers, who are large banks and financial institutions who are obliged to bid on newly issued government debt, buying a higher percentage of the auction than is usual in a number of instances. When we look at the net US Treasury holdings for these primary dealers, we can see that it has been rapidly rising since the beginning of 2022, where it was around $70 billion to now being over $200 billion. And central banks from countries across the world are starting to pull back from their investments in US bonds, and in some cases even starting to dump their US bonds on the market. We've already seen Russia sell all of their US Treasury holdings, and China, the second largest foreign holder of US Treasuries, are continuing to sell off US Treasuries at a rapid pace, putting a lot of downward pressure on US Treasuries, which puts upward pressure on the yield that needs to be paid by the US government on future debt. China's holdings of US debt had been steadily declining since they peaked in around 2014. However, over the last couple of years, the pace of these sales has really accelerated. This now puts China's holdings at around $750 billion, a significant decline from over $1.3 trillion just 10 years ago, and is now the lowest amount of US debt that they have held for over a decade. US debt growth really did explode post-2020, and so this acceleration we have seen in the sale of US debt from China is correlating quite closely with this, suggesting that China believes that the US debt situation is becoming increasingly out of control and wants to reduce their exposure quickly. And what's worse is that the number one foreign owner of US debt, Japan, is now on the verge of a $400 billion fire sale of their US debt holdings, which it may need to carry out to buy Japanese assets and prop up the declining yen to support the Japanese state-owned government pension investment fund. Now, the fund is worth over $1.5 trillion and contains $400 billion in US Treasuries, which, if all were to be sold, would equate to roughly 20% of the federal government's net annual borrowing. A 20% increase in the supply of US Treasuries is very large when yields are already pretty high and could go higher. With weaker demand for new US debt, buyers will need to be enticed with higher rates, which is of course going to increase the interest payments that the government needs to pay on its debt, which in turn would drive larger budget deficits and more debt. Now, with all that being said though, the Federal Reserve may come in to save the day, as a number of rate cuts are being priced into the markets for the remainder of 2024. Betting markets are now predicting 4 rate cuts for the remainder of the year, which means a base case minimum of 100 basis points of interest rate cuts. And in fact, for the next meeting in September, a 50 basis point rate cut is what markets are now expecting to happen, which is a sharp increase from what was expected just a week ago. The main reason why the market has suddenly shifted and is now predicting these rate cuts is because there has been a flurry of recent bad economic data that is signalling a recession is imminent. The unemployment rate just spiked to 4.3% and is on an upwards trend, which is likely to only keep going higher. July's jobs report was much weaker than expected, and many companies are coming out with weak earnings reports and telling investors that consumer spending power is weakening. On top of this, there are also a number of other recession indicators that are still pointing to a US recession very soon, like the bond yield inversion reverting. Now, if rate cuts do indeed start and begin to ramp up over the next 6 months or so, this is going to help the government with debt maintenance, and this will impact bond prices and means that new debt taken out will have a lower interest rate. However, in a major recession scenario where there is complete economic collapse and interest rates fall to extreme lows, then the US government will be facing a whole load more critical problems that will outweigh lower debt payments. Now, the housing market is a specific area of the economy that could see a collapse very soon, as there is a lot of new data that is signalling that we're about to see home prices crash, only contributing to a wider economic recession. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.